Hello, I'm Madani Ariam. This video about invoice financing. Many businesses face cash flow problems because of the delay in receiving payments from the customers, which brings many difficulties to the companies. They use invoice financing to overcome that issue by receiving 75% to 95% of the value of the invoice from the lenders. The invoice finance provider takes control of the payment, such as making the payment for a single invoice or a complete sales ledger. These are the options where the finance provider takes possession of it. Whatever the situation may be, the customer becomes aware the supplier took finance on their invoice. In principle, invoice finance is a type of working capital funding that can help with the cash flow management. The provider will charge an interest rate and fee for managing the credit in most cases. It is usually a percentage of the turnover. What is invoice financing? Invoice financing is when you use an invoice to issue an invoice to a customer. You receive a percentage of it as a loan from a lender when you submit the invoice to the lender. It could be a bank or an invoice finance company. You will receive the payment within 48 hours of submitting it. There are many different invoice finance providers in the UK, ranging from specialist invoice finance companies to banks and other financial institutions. It would help if you issued an assurance to the lender that it will get paid when you give an invoice. Are you an established business with a trading history? A lender will ask you to prove that you issue invoices to customers to ensure they get paid. It is a way of borrowing money from the lenders on invoices that a company issues to its customers to use the money to pay their suppliers and employees to reinvest in its business to improve the way to grow their business. They find this a better option than waiting for their customers to pay the invoices in full. Businesses pay a percentage of the invoice amount to the lender as a fee for borrowing the company. Invoice financing can solve problems associated with customers taking a long time to pay and difficulties obtaining other types of business credit. Invoice financing is also known as accounts receivable financing or simply receivables financing. Understanding invoice financing. Businesses sell their goods or services on credit to large companies like wholesalers or retailers. Therefore, purchasing company does not have to make payment immediately, and they get an invoice stating the amount due and the date of payment. However, offering credit to clients ties up funds that a business might otherwise use to invest or grow its operations. Companies may opt to finance their invoices to finance slow paying accounts receivable or meet short-term liquidity. It's a short-term borrowing to help its operations carry out without delays, allowing them to grow its business. Otherwise, they will run short of working capital if they face such a situation, which affects the company in many ways that cannot keep up the operations well. Invoice financing from the lender's viewpoint. Lenders have an advantage from this type of transaction. They have some security from collecting the money from the customers instead of issuing unsecured loans to businesses, as invoices act as collateral for invoice financing. The lender also limits its risk by not advancing 100% of the invoice amount to the borrowing business. Invoice financing does not eliminate all risks since a customer might never pay the invoice. It would result in a complex and expensive collection process involving the bank and the business doing invoice financing with the bank. It's a type of financing that a small business might find it difficult to obtain from reputable lenders, but you should try many funders to see success. I hope you like this video. Thank you very much for watching my video. Thank you. Bye for now. See you in another video. Thank you.